This is a panel discussion on consumer credit steering and promises to be an exciting set of topics. It compares how two countries approach the idea. And to lead this discussion, we have Adam Feibelman and Renuka Sane. People, the floor is yours.
Thank you, Susan. Can we have the slideshow? Okay, so I want to welcome all our panelists. It's kind of weird because I see some of them in the room, but some of them I still don't see yet because I see my screen. But hello, everybody, and thank you for agreeing to be on this panel. So this is actually a panel or a slideshow that has. This is a story that has evolved, with Adam and me talking in response to something that we saw in the US markets about the establishment of a public bank. And some of our experience in India was, this is such a bad idea and you should not go down that way because our experience has been so bad. And that's how we started talking about consumer credit steering, the role of government in credit markets, whether it works, whether it doesn't work. So to just set up some context before we start talking, we know that consumer credit markets have a lot of problems. One of them is financial exclusion. We worry about it a lot in India. We know that in the US also there are a lot of concerns about exclusion of the poor, of minorities, etc. In India, we've always had a problem of inadequate access to long-term finance, for example, infrastructure. The problems of poor consumer protection are very well known. Consumers get missold products, especially on credit in the US, credit and insurance in India, UK, you have it. And all the countries in the world have therefore had various policies for steering credit and financial services over and above just regulating the credit space. And this brings us to the question of how do governments typically steer credit? One way they do this is through the ownership of the lending channel itself, which is in India, for example, in the 60s, 70s, we said that we wanted public sector banking, and most banking in India is owned by the government. We also set up a lot of DFIs in India, and since then we've kind of decided to go away, but then we've decided to come back into this space. The second way in which governments steer credit is through rules on credit dispersal. So we have a program of priority sector lending in India, wherein the government mandates the banks to disburse about 40% of net credit to certain sectors that it deems priority sectors. The definitions of these sectors may have changed over the years, but since 1960 or so, we have had PSL in India. There is a similar program which is not quite similar, which is the Community Reinvestment Act. It is far more voluntary in the US, but still there is an attempt to doing priority center lending or steering of credit to certain sections or certain areas in a particular jurisdiction. And the third way that the government steer credit is by providing liquidity to markets. So we have credit guarantee schemes in India. You have Freddie Mac, Fannie Mae, and all kinds of insurance that the government provides so that private markets might lend more. What we have seen, or at least what we observe, is that these systems of steering credit have led to vastly different outcomes. PSL in India, for example, it obviously improves outcomes for those who get the credit, but overall cost to the system is not known because there is an opportunity cost to this. There is a cost to the banks of forcing them to put 40% of their net bank credit to certain priority sectors, and we've never really been able to measure the overall cost. Public sector ownership of the banking channel in India has not worked well at all. There are papers that show us the effects of employment, high NPAs, politically motivated lending, the failure of DFIs, you name it. And the credit guarantee schemes have also seen very high NPAs in the country. So in India, we are a little concerned about how government ownership and government playing a central role in credit markets actually gives us very poor outcomes. In the US, however, there is some criticism about distorting the market. And there seems to be a view, and I'll let the US panelists tell us a little bit more about what the position in the US is. But from what we see, we feel that the view there is that there should be more steering, maybe because it's largely a private market, and then you do want a little bit more government intervention. And that brings me to this question of, fine, what do we learn from this comparison between the way the US steers credit and the way India steers credit? So one is the difference between these two economies in the way the credit steering is done that different? If so, why? And how much do these matter, which is that the structure of the scheme itself. So if one looks at how PSL is done versus how CRA is done, there is a remarkable difference in the structure, in the mandates of both the schemes, and maybe that makes a difference in the size of the intervention. So we have very high public ownership in India, whereas in the US they are envisaging a much more limited role for the government. Maybe that makes a difference. There are huge problems of institutional capacity in India. Low, weak state capacity is a problem, and so when government takes control, the outcomes are not particularly great. And maybe because our regulatory capacity is low, when we design schemes with very high government intervention, perhaps we don't do as well. If we were to transplant this in the US, at least at current state capacity, maybe we'd see a different outcome. Of course, then the question is, does high government intervention lead to a weakening of state capacity because you have all of these public choice problems of rent seeking that come about as the government share of the market grows? And this leads me to ask, how do we think about designing these interventions? And so, that's where we really are in terms of the various questions on how credit steering works. And with this, I think I will move to the panelists. Can we stop sharing the slideshow? So I want to then move to the panelists, and I'll request the panelists to introduce themselves in a brief minute and then respond to the questions that I have, that Adam and I have specifically for them. So I'm going to begin with Nadav. So Nadav, our first question to you is, we know that you were involved in setting up of the public bank in the US. And we'd like to hear from you, what was the motivation for setting up such a state bank? You already have the CRA, so why was the CRA not enough? And why do you think that the state intervention will not create new problems, such as rent seeking, corruption, of all the kinds of things that we are concerned about in India? So over to you, Nadav.
Thank you so much, Renuka. Can you all hear me all right?
Yes.
Great. Yeah, thank you so much. I heard about this group for years, so it's really a pleasure to be able to join all of you and learn from all of you. So I have been involved in a legislative proposal to start a public bank in Massachusetts. It is still a bill, so it's still pending committee work and a vote by the Massachusetts legislator, still not a live policy project. But there's been a lot of learning from this, and there are similar proposals to start these types of state-owned banks in several states, including California and New Jersey, that are quite advanced. So this is mainly what I'll talk about in the 6-7 minutes to come, and I'm glad to definitely glad to refer more broadly to the Community Reinvestment Act and to the government state enterprises in the US. Okay, so I think the first thing that's really important to understand about the proposed bank in Massachusetts is that it is small. It will be one of the smallest banks in Massachusetts. And its deposit base is going to come from the state treasurer. So right now, the state treasurer of Massachusetts holds a liquidity buffer of about $10 billion. And that liquidity buffer is held in a money market fund that has investments all out of state, many of which out of the US entirely. So I think the basic thought is that at the same time in Massachusetts, there is a substantial demand for credit in underserved communities. So these are especially communities of color. And these are communities that for decades have experienced financial and economic segregation. And today, their lack of access to credit, which is a result of this segregation, is an important driver of the racial wealth gap. So the basic idea is to match that need with the cash portfolio of the Massachusetts state treasurer. And there's quite a bit of quantitative work that has gone into this, and I want to talk about a few different aspects of that. So one aspect is that there are in the United States a set of financial intermediaries known as Community Development Financial Institutions, or CDFIs. So that's an acronym that I'll refer to, CDFIs. So the CDFIs are almost entirely non-banks. They don't have access to deposit funding. And because they don't have access to deposit funding, their funding is actually quite expensive. But they do very important work in providing credit to minority communities that banks will not. How do they do this? So we looked at the portfolios of the CDFIs, and this is all joint work with Christine Dezan from Harvard Law and Michael Swack from the Carsey Institute in New Hampshire, and other activists that are involved in public banking for Massachusetts. So we looked at their portfolios quite closely, and what we found was that the loss rates on these loans that CDFIs make, and that banks will not make, are actually comparable to commercial bank loss rates. Same NPAs. Very, very similar. Very, very striking. A very, very striking observation, right? So here is a set of here are communities that many people say are not bankable because they are too risky, because they do not meet traditional underwriting criteria. And that's an attempt to rationalize the fact that they do not receive adequate credit. And what we see is that CDFIs are actually able to underwrite these loans with NPAs comparable to banks. So how is this possible? And I think a big part of the reason is that CDFIs offer technical assistance. So they're not just arm's length lenders like banks. They actually help with financial education. They actually help with developing business plans, with ongoing advice when borrowers face difficulties. And these are things that dramatically reduce loss rates, making otherwise unbankable borrowers bankable. But this is expensive. This kind of technical assistance doesn't come for free, which means that if we could support CDFIs, for example, as one of the type of borrowers that the Massachusetts Public Bank, if adopted by the Massachusetts legislature, would support, if we could support CDFIs, we could indirectly promote this kind of lending to underserved communities. And then just one last point about the kind of research that we've done. That research shows that a public bank can actually provide these subsidies on a meaningful scale, because one of the main reasons is that the cost of operating a public bank is very, very, very low. Operating a commercial bank involves considerable operating costs. We need branches, we need information technology, marketing, et cetera, et cetera. With a public bank, there's essentially only one depositor, that is the Massachusetts State Treasurer, and that provides very considerable savings that have been quantified. And the basic idea is these savings could actually be passed on to the borrowers of the public bank as cross subsidies, And in that way, they could encourage responsible lending, right? We've seen the work, we've seen the NPAs that are completely acceptable. It could encourage responsible lending and contribute to development in communities that are facing hardship. So this is all just the first question, taking up Renuka's invitation to talk about a credit steering scheme with institutional specificity. Second question, and I'll be a lot briefer. Why are things like the Community Reinvestment Act not enough? So Renuka talked about priority sector lending in India and how 40% of net bank assets have to be compliant with priority sector lending. In the US, Community Reinvestment Act credits are given to less than 3% of bank assets. Okay, so it's a tiny fraction of the US banking system. That's number one. Number two, the CRA is not particularly designed to deal with the issues that minority communities are facing. The CRA has a low income goal, not a minority goal. And the differences are actually quite different. So we have excellent work from sociologists and demographers that have shown that the challenges facing segregated communities are qualitatively different from those that are facing white, low-income communities in the US. And most low-income households in the US are majority or are white, just given the demographic differences. So I think from a development economics point of view, it's quite a different challenge. Third difference, no technical assistance. So Community Reinvestment Act lending is typically, some of it works through CDFIs, but most of it is just traditional commercial bank lending, which means that this is arm's length lending. It has to be safe and sound and prudent. If banks cannot offer this technical assistance, they basically cannot access the borrowers that the CDFIs can. I'll very briefly mention the government state enterprises, Fannie Mae and Freddie Mac. It's important to recognize that in the US, these government state enterprises serve primarily a middle income, not a low income constituency. So they absolutely increase. Right. So in the US, these government state enterprises, they serve a middle income constituency, which means that they broaden access to credit to the middle class, but at the same time, they could even aggravate access issues to low income households because housing prices are so high. Last comment on Renuka's third question, public choice aspects, which is very, very important, and it's something we gave a lot of thought to. So one observation is that this is a very small bank. This is going to be a bank with assets of about $1.5 billion, one of the smallest banks in Massachusetts. It's going to have a very large pipeline of very attractive projects, just because the projects that it could fund are on a scale that is so much larger than its resources. So I think that that's one mitigant. We think that it would have the ability to choose really, really, really promising projects. A second aspect is the governance. So there's a very careful institutional design in the bill that really populates the leadership positions in the bank with people who have considerable experience in community development and considerable support from the community development community, which we believe will lead to accountability. There are very serious reporting requirements, and the bank is going to be regulated just like any other state bank by the Massachusetts Division of Banks. So as far as corruption, inside dealing, etc., it's going to be subject to the same basic set of rules that applies across the board to private sector banks. Thanks a lot. Really looking forward to hearing observations from India and continuing the conversation.
Thanks a lot, Nadav. This was very, very interesting. What I take from this is one of the most critical differences is how small this public intervention is vis-a-vis what we do in India. I'd like to turn to Harsh now, who has considerable experience with banking and DFIs in India. We know that they were not so much about consumer credit, but still. So I'd want to, turn to Harsh in light of what Nadav has said. How would you comment on why is it that our DFI experience in India what went wrong with it, and what advice would you have for Nadav as he, kind of starts thinking about, or people in the US start thinking about increasing the public sector presence in banking in the US?
Good. So I think the first clarification is that they were exactly not about consumer credit.
Exactly. Yeah.
They were meant to do industrial project finance. So broadly, see, in India, the state intervention in finance, in directing credit, went through three phases. I call them the nationalization phase, the institutions phase, and the regulatory phase. Let me explain. They were not necessarily completely distinct. There was a little bit of overlap. So from independence till about early 70s, we said, if you have a problem of credit, I'll nationalize it. So we nationalized banks, we nationalized insurance, we nationalized asset management, we nationalized everything we could lay our hands on. Okay, so by the early 70s, the entire financial sector was nationalized. Then they realized that, well, that doesn't work fully. So then came a phase of setting up specialist institutions for directing credit to specific segments. So we started with NABARD, IDBI, SIDBI, all these characters came around, all these entities, which were basically aimed at providing credit to specific segments. Now, and the DFIs were these, which were meant to give a specific type of credit to a specific type of borrowers. Now, important to note that that was a time when everything in financial sector was regulated. The interest rates, who can lend, do what kind of lending, to whom, when, how. So therefore, there was no consideration of economic viability of their model. Where would they raise funding from? How would they rent? How would they manage risk and so on? So that's why they flourished, because banks could not do project lending. It was left only for these DFIs, which did not compete among themselves. So if you have all the industrial licensing was regulated. So if you managed to get a license, you were a lucky few. And then you went to these people to get loans to set up those industrial projects. And they will lend in consortium. The interest rates were governed. So there's actually not, this was almost like government departments giving money. Now, how did it unravel? It's when we started liberalization, when we started deregulating interest rates. Then people suddenly said, but how do these folks raise money? Because when in the regulated area, their bonds qualified for liquidity ratio for banks. So banks had to invest in these bonds and they were giving higher yield. And so they were like government bonds giving a little bit of a higher yield. So obviously they had an assured source of funding. So that started unraveling when the overall financial sector reforms happened. Everything started getting deregulated. But then we went into the third phase of state intervention, which I call the regulatory phase and the schemes phase, which is now government says, if I have a problem, I'll give you a regulation or I'll make a scheme. So Mudra is a scheme. By the way, NABARD started like Mudra. NABARD started as a refinancing agency for agricultural loans. You know what's its share of total agricultural lending in India right now is less than 0.5%. So it has lost its original purpose. It keeps reinventing itself, finding a role for itself. So I think my own sense is that these kind of government entities work if the rest of the sector is also regulated and has strong state control. Standalone in a competitive private sector, good luck to the Massachusetts Bank. I don't know how much impact it will make actually. But to my mind, it raises a deeper and more fundamental question, and I'm doing some work on it, so I love to get comments. And the basic question is efficient allocation of credit, or I'll broaden that to say efficient allocation of capital a public good? And I believe I can build a case that it is, because then that gives you the basis of state intervention. Because then the only question is the extent and the mode of state intervention. I'll close by just one example. The best state intervention in consumer credit, Renuka, has been an innocuous law passed in 2010, which mandated all consumer lenders to share their information with credit rating bureaus. Consumer credit was 1/3 of industrial credit in 2010 and 17% of total banking credit. Today it's 32%, bigger than industrial credit. The singular reason for this is that law, in my opinion, because what it did is that it took away the informational advantage of incumbents, and it created a level playing field for everybody. More has been done to give credit to poor people in India by private equity funded, red meat eating, return seeking microfinance entities than by government owned banks. And they could do it partially because of this law, because their credit bureau coverage is so much better now. To me, that's the model of optimal state intervention. Government did not set up credit bureaus. It did not finance them. It did not regulate their pricing. All it said, a law mandates you to share your credit information. I think that should point us to what the optimal state intervention in providing this public good called efficient allocation of credit is. Thanks.
Thanks, Harsh. Very interesting question on the kind of intervention. I'll turn to Deepti now because this is in the same line of what we've done in India. So Deepti is an expert on priority sector lending. So I'd like to sort of ask you, what is your view on where PSL is, why PSL has not really worked, what kind of, what should we be doing differently to make priority sector lending work? Because it's a very important part of how we do credit steering in India.
Yeah. Thanks, Renuka. So maybe I think we should, here our objective maybe to consider, how could we achieve the goals of priority sector credit while at the same time sort of minimizing market distortions and allowing banks to pursue whatever is the most effective strategies available to them. So Renuka, I'll come at it from this point of view. So I'll first talk about structure as a policy. As you all know, it's 40% of adjusted net bank credit of the previous financial year. It's not based on disbursements. It's on a stock figure, right, which is credit outstanding. There are some targets and sub-targets that are applicable for specific sectors and subsectors. And the target achievement is assessed at the end of the financial year. So that is March end. And a kind of average quarterly achievement of targets is used into sort of calculating what the final year achievement, end of the year achievement is. Penalties are fairly steep. Penalties are calculated at the end of the financial year. And we also have, so although it's 40% for commercial banks, there are certain categories of banks that the central bank has created, such as the small finance banks, the urban cooperative banks, and the regional rural banks, who have even a much higher percentage mandatory requirement of 75%. Contingent liabilities like guarantees are not considered as priority sector. So there's clearly a bias towards originating actual loans. And so I would say that here we have static targets on the balance sheet level of the bank, not on regional or kind of any kind of demand-led metric. And banks have a fair amount of flexibility in deciding which parts of the country they want to operate in, which sectors they want to operate in. It's another matter that we don't see too much of a difference in business models across institutions. Now, coming to kind of system level capacity, here I think I'll talk about how do PSL books get created, what are the kinds of permissions available for partnerships as well as trading of credit risks, right? So here I would say that over the past maybe 1.5 decades, there's been increasing ways in which banks have been trying to meet these targets and avoid penalties. So early on, I think kind of similar to the CDFI construct, but where technical assistance isn't a significant part. There's really entities called Nbfcs in India. These are entities that sort of borrow from the markets and from the banks and lend to retail or wholesale borrowers, right? So microfinance entities were in some sense allowed to receive loans from banks and this qualified as PSL. And I think that led the way to the tremendous growth of microfinance in India itself. But so I think there are 2 or 3, maybe 4 kinds of pathways in which banks can decide how they want to do PSL. So it's a combination of all of these. One is directly through own branches or by lending to entities that will, or not even buying, I would say by, getting into contracts with entities who have last mile capabilities. Second is really to say PSL certificates. So you could trade in the kind of value of the value of credit of the PSL itself, whereas there is no actual movement of credit risk from the seller bank to the buyer bank. And these certificates expire at the end of year. And these are certainly cheaper than incurring the penalty that is there. But it does not, we're not sure whether it actually creates new credit, right? Because it just sort of reallocates whatever credit has been created so far. The third, I think, is really around, so banks have permissions to purchase PSL, sorry, when I say PSL, it's priority sector loans, PSL credit from NBFCs and anybody else who's out there, but they can also build their investment book with paper or securities, pass-through certificates, where the underlying loans are PSL eligible. So I think these are the ways in which PSL is, in some sense, there is a full ecosystem of actors who have progressively supported banks in making sure that they're able to meet these targets. So certainly there is a cost to the system. Direct origination PSL is actually very expensive to originate, and all of these partnerships that I was talking about really help to bring down both the OPEX as well as the the loan loss provisions, where you don't know what the expected loss is, and and so I would say that overall cost to the system has progressively been coming down, but is still high. There are distortions in pricing that further add to the cost. One is, of course, interest subventions schemes that Dr. Harshvardhan was talking about, but they also have sort of interest rate and margin caps, right? And this just means that it becomes all the more difficult for entities to really service the more difficult geographies or sectors. So I think then our final question is, has PSL been effective so far in meeting social objectives? It certainly has increased access to credit, but there's a lot more that can be achieved. We know that there is considerable kind of regional disparity, regional variation. And to correct this, the central bank has actually introduced a new system which kicks in, I think, next year, this financial year onwards, where the regulator has really come up with a rudimentary kind of process to classify districts across weightages such that depending on which kinds of districts the banks have exposure to, you get a relative number in terms of how much of PSL you have achieved. So, which means it's an incentive system, right? You're incentivized to go lend to or build book from regions which are underserved, whereas you're disincentivized to lend to or build books from regions or sectors that are overserved, right? Or where they have considerably greater access to PSL credit. So I think we don't know what the effect of that's going to be, but that's something that we are all keenly watching. I would just say that, to end, I think we shouldn't lose sight of the process design that really enables banks to have flexibility to design how they want to build their strategies for their PSL book. So this means that you have to remove any inconsistencies that may exist between different permissions around PSL, either on the kind of entity that you partner with or the type of instrument that you use. So which means, a bank should be entirely possible for a bank to even build their entire PSL book by just partnering with entities, or by just building an investment book completely from some securities where the underlying is PSL. And I suppose I would stop here by saying that this is perhaps kind of like the long-term vision to aspire to, when we are thinking of both modernizing the banking system, but also making sure that this is an integral component without losing sight of goals. Thank you.
Thank you, Deepti. So lots of themes going on here, starting from whether governments should intervene, in what form it should intervene, what the overall market looks like. Is it a private market with a small intervention? It is a largely nationalized market that is slowly liberalizing, but then adding new schemes every couple of years. So I think I'll come to Indraneel now, who's sort of studied both these markets. And I'd like to ask Indraneel that, what do you see as the difference in the way credit steering is done in both these markets? And do you think that the differential way in which these two economies approach credit steering explains the differential outcomes that we are seeing here? And, again, I'd like you to comment on, based on the India experience, what would you say to the US as it moves towards, even though it's only increasing its share of public banking in a very small way, in a very measured way, but how should they be seeing some of these issues?
Thank you, Renuka, for the opportunity, and thank you to the organizers for including me. I have the privilege of working on Community Reinvestment Act as a topic of research, and also on the Indian public sector banking and private lending as another topic of research with Apurv Javadekar and Rodney Ramcharan in India. In US, one of them is in India, ISB, and the other is at USC. Let me quickly point out a couple of things first about Community Investment Act. One of the papers I have is with Vidhi Chaucharia, Ronghai, and Pritu Vatsa. And what we find is that a lot of credit is steered in as Deepti and Nadav were pointing out, in a different manner from the Indian system, where it's you have to meet these quotas. There, the idea is in each assessment area there is a benchmarking. Well, how much is the other bank lending, and where are you in comparison to that? So that allows a little bit of flexibility, and also some tight competition between banks in tighter geographical regions. And what we find in that paper is that, and we try to do some quantified analysis, and we find that about $20 billion of additional lending is getting done because of the Community Reinvestment Act, and it is moving about 500,000 to 750,000 people, depending upon estimates, out of poverty through lending. It comes at a higher cost in terms of losses, right? So bank losses are higher in loan losses, about $2.67 billion, but it also improves ultimately the total amount of welfare. It reduces the welfare expenditure in those areas because people are moving out of poverty, and that effectively helps the government balance sheet in a different manner. So that's one part of the thing. In the US, also there is Small Business Administration in general helping loans. And as Nadav was pointing out, there are these loans which are made through community development financial institutions, and there is a US Treasury fund already, which is lending side by side to the private capital of CDFIs which have been licensed, right? And so when I look and when I learned more about this to participate in this, I think that this $1 billion experiment, if I may say so, of Massachusetts would be an interesting way to kind of look at, okay, how are we moving from a public-private partnership almost, right, in a certain case, or regulatory intervention, to another world where $1 billion bank is established, and seen how that works. I just want to point out, $1 billion is truly the small bank, large bank distinction. Below $1 billion, a lot of regulatory restrictions do not even apply on US banks. So it's really, really tiny. But I would also like to point out that there is a lot of US government intervention in credit steering, right? And I think we don't think about that as much. You pointed out, Renuka, that Fannie, Freddie, etc., are doing a significant amount of steering. I would like to make a comparison. $250 billion worth of issuances of mortgages are backed by Fannie, Freddie, agency-backed mortgages this month, right? In the month of November in the United States. So it's not that US government is not participating, and we know that there were significant losses at Fannie, Freddie, which US Treasury had to, backstop. So there is a lot of that. In the context of India, what I have found is that in our paper we see, and perhaps this matches the intuitions of many of the participants, that public sector banks have consistently lent to riskier firms. And this is not because, and various dimensions of risk, right? We have tried, and it's not because they're trying to help smaller firms and so on, right? So, and that's happening, and they're sometimes lending to consumers, but again, they're taking the riskier consumers and so on. So, even though, Renuka, you asked me about the differences between the two countries' experiences, I find that there is a lot of commonalities which, strike me as there's a lot of mishmash of approaches, right, that is going on in both countries. And I think perhaps that some of it is good because, there is no need for a unified approach. Let's see what works to a certain extent. And I like the fact that in India, the private sector, private banks have come in full force, in more force after 2011, 2012, when deregulation happened. And they're taking more market share, but at the same time, they are improving the allocative efficiency of capital that we are seeing. And so what I will, if I were to suggest something for my US friends, I would say that, yeah, try it out, see how it works, right? But there is a lot that is going on already. So it's not such a novel idea that, because I think SBAs and Fannie Freddie mortgage backing is something that US should think about more carefully compared to, for example, many other countries where that level of government-backed support for mortgages is not there. But in the context of India, I would point out that, yeah, I think allocative efficiency can certainly be improved if we take more time and opportunity to allow private banks to participate in a larger in a larger scope.
Thank you, Indraneel. And before I sort of open the panel, open the floor for questions, I'd like to come to Adam and ask Adam to reflect a little bit upon how he sees India versus the US differently, and what suggestions does he have for us here?
Let me just say, I don't dare make any suggestions, but I do, first of all, just want to say hello to everyone, and it's great to be participating in this conference again, but I'm sad to be doing so from my living room and not there with you. I actually am going to get out of the way quickly because I'm eager to hear the conversation, but let me just say that this is exactly thus far the kind of discussion that I think Renuka and I had hoped when we were thinking about this panel. That and from my perspective, really, I just think this is a very interesting case study in comparative analysis because it's in 1 minute these look like very similar kinds of questions and approaches, and then if you turn it slightly differently, then it looks like a completely different set of issues and concerns. And so I think it's really fascinating to think about what we can learn from in the US from the experience in India, and whether what has been going on in the US has any utility for policy making there. I guess the one thing I would just add, I would put myself kind of in the camp with Nadav of people who aim to see the kind of CRA expanded. Although Nadav didn't exactly say that, I'm kind of assuming that, but at least the function of something like that expanded, and I'm enthusiastic about the prospect of the Massachusetts Bank, but I do think that this is part of it's important to note, part of a broader, I think, movement may be too much of a word, but probably not. But there's, for example, a very kind of prominent proposal here for a national investment authority that's gotten a lot of attention for more kind of infrastructure focused lending and similar projects like that. So I do think it's a moment in the US where a significant kind of segment of the kind of academic commentators and policymakers are looking towards a much more aggressive public role in kind of steering financial markets and allocation of financial resources. So I think this is a very, very important set of questions, and assuming that there are lessons to be learned from the comparative analysis, this is a very important conversation. But I think that's all I want to say for now, and reserve perhaps the right to jump into the discussion as it develops.
Thank you, Adam. I think we'll now open the floor to questions. But Harsh, I know you had a comment. So before the audience comes in,
it was a very short comment, which is that the priority sector, that 40% has been there ever since it started in the 70s. Even the sub-segment, because there is a huge political economy. Every line item has a lobby behind it. So what keeps happening is we keep redefining what agriculture means, for example. So at least 4 times we can't seem to agree on what agriculture means. So that's what happens in the PSL norms.
The floor is open. Any questions? Susan.
Yeah, I do have a common question. I think what I heard Nadav say in terms of the steering of the credit is slightly different from what we are doing that relates to your point, Harsh. Right? This law comes up, it reduces information asymmetry, and across the board, we have the level of the waters rising, so everybody benefits. Whereas here, what Nadav said is, look, that's not the issue that the plan that they are making seeks to address. It's about segregated communities. So it's not about necessarily the commercial quality of the credit, but about something else, right? So why do women not get as much credit as men? Why do some communities get shunned? So I do not know whether just the information asymmetry that we are traditionally used to thinking will help in this problem. So I agree with Indraneel that it's an interesting experiment, right? If we set our mandate and our objective correctly, it's slightly different. I think it's more to the PSL kind of a target where we said, I don't think it's equivalent, because I remember reading the old traditional PSL documents and they said, no, we want this to be a sector that is, given more credit because it's important for the country, blah, blah. It was not the segregated communities which are not getting credit because of non-visible commercial credit kind of reasons. And I think it's a different distinction here that they're trying to solve. So I'm not sure that we can compare the objectives of the DFI or even our PSL to what Nadav described as getting past the barrier of some sociological, cultural, psychological barriers to credit lending. And I think that's why it's a slightly different problem.
So then the issue is a dedicated institution versus getting normal commercial institutions to do it. Even the PSL has minorities, weaker section, lower caste as sub-segments, which are exactly segregated communities for us. So it's no different. It's just that we are not setting up a dedicated institution. We are making commercial banks do so, and they run very high NPAs.
No, but we are co-opting, or we are capturing part of. So it's like saying we don't really necessarily differentiate between one institution versus the other, but we are directing them. So they are putting it all into one bucket.
But Susan, we've also had, for different segments, we have had different schemes dedicated to one kind of a community, for example, or one size of a loan, for example. So many of these experiments, at least to the best of my understanding, have been tried out in India. And the other point that strikes me is if credit is not available to certain communities because of some sociological, psychological barriers, why is it that more entry into credit markets by different kinds of institutions not solve the problem? So in some ways, we solve the cost problem with MFIs.
Yeah.
Why do we not see more entry? But Ajay, you have a point.
Just 2 quick points. I was playing with this in my mind. I thought it was a very interesting idea that there's a $10 billion liquidity buffer, which is ordinarily stored in a money market mutual fund where yields are like 0. So in a way, the break-even return that the proposed new institution has to achieve is pretty low. It's got to get to about 0. Okay, so it's really, not very demanding in a certain way.
But it could lose capital.
So the question is, the interesting question is, over a 25-year period, over a 50-year period, does this thing manage to stay solvent while achieving a certain hurdle rate for return? I think that's a nice and interesting way to pose it. And I would like to say it's very healthy that they have avoided the distortion on the other side of what we get in India, which is that a government-backed institution is always an unfair competitor when it comes to the deposit side. So I think that's interesting and intriguing that you're not distorting the market for deposits and you're going into a market for lending where the opportunity cost is manifestly low. So you're not really loading an unfair cost upon the exchequer. So it's interesting. Of course, the question would be that, are we convinced that on a 50-year horizon, this thing will work? Okay, so for example, organizations like Freddie Mac and Fannie Mae did blow up on 50-year horizons. Okay, so 50 years is a long time, and public sector guarantees have a way of becoming bad. Also, it's very attractive when you say to me today that it's $1.5 billion, but it is in the nature of real world political economy that these things don't stay small. There's a fundamentally corrupting influence of government initiatives in public life. And the danger is that in 20 years, it will go to 100x the size, and by 40 years, it will blow up. And we've got to think hard about these things before we start them.
So I think Nadav does want to say something. So do you want to respond, Nadav?
Yeah, so thank you all. This is incredibly thought-provoking in so many different directions. But one thing I wanted to say was I just wanted to reiterate this. If folks are interested, I'm glad to share the testimony that we've submitted recently. There is a pro forma for the proposed public bank. There is an analysis of its return on capital. And one of the things that I would really like to highlight, and it ties to very important points by Ajay and by Indraneel. The government is not like a private investor in the following sense. The government holds the tax base. So that means that unlike a bank, when a bank is making a loan to a community, and that loan might not be very profitable in a portfolio sense, but it might have all sorts of positive externalities. It might lead to economic development, might create jobs, it might increase income tax, et cetera, et cetera, et cetera. The ability of a private lender to recapture all of these externalities is very, very limited, right? A private lender has a business model that ultimately relies on interest from its lending minus charge-offs, et cetera, right? Not so the government. So when we do this kind of modeling in a technical sense, when we think about the return on equity that Massachusetts will have as a state, one of the things that are really promising to do is to actually account for that economic development, look at its implications on the state's fiscal stance. So in Massachusetts, there's a flat 5% income and sales tax, and incorporate that into the return on equity analysis. So I think that's one point that's really, really important. Second point, there are many others, but I'm also anxious to hear other people speak. Fannie and Freddie. Fannie and Freddie blowing up. And by the way, that's such an important point that Indraneel made. 250 billion on a flow basis, 10 trillion on a stock basis. So if you look at government state enterprises in the US pre-COVID, about $10 trillion in total debt, which is the size of the corporate bond market. Okay, so again, like this point about comparing the US and India in terms of the scope of credit steering, it's enormous. The main problem with Fannie and Freddie in 2008 had so much to do with conflicts of interest that were about their private ownership. So their nationalization in 2008, they had private shareholders, they had private executives, they had rampant conflicts of interest problems. We have not seen these problems since they were put in government. Since they were put in government conservatorship, and I think that's also something that's really important to take into account. Thank you.
Okay, I see Bhargavi and Deep put their hands up, so I'll start with Bhargavi.
Hi, sorry, I actually had a question which is very similar to Ajay, but I had a more sort of detailed question, Nadav. So if you don't mind, just for my understanding, the government will be contributing to the equity capital as well as it will be the equivalent of the deposit base as well, right? So no public funding involved actually, in the sense that no public markets involved as such, right? Have I got that right?
Yeah, that's correct. There's a $200 million appropriation on the state budget. That's the only budget item. Other than that, there's a transfer of 1.4 billion in deposits from the money fund.
Understood. So then how do you override the problem of credible commitment? Because it seems to me that if you want to be able to scale this, then year on year, you need to be able to have that commitment from the exchequer. So you plan to build that in the law itself?
Thanks. It's such a great question. So there is a provision in the law that says that the deposit base will grow based on an index. It's not going to grow enormously. It's basically going to grow with the overall cash portfolio of the Commonwealth. So that's the growth of the deposit base, and the capital will basically only grow from retained earnings. And this has been modeled to show that there could be a slow, reasonable rate.
Understood. Okay, just one last comment. Just, I think that's the fundamental difference, right, between the Indian model and the Massachusetts model. So just in terms of where the capital comes from, because we have public sector banks also raising deposits from the public, but lending it out with different targets and stuff. And the other thing is that it seems to me, I don't know, but the idea of narrow banking comes back to me, and the idea that you will concentrate all your lending to a certain segment of society. It seems to me that, actually diversified lending can help you diversify your risk so that you're much better off when it comes to the rate of return. But I guess if it's really money coming from the exchequer, maybe that's not so much of a problem. But if you had deposits, on the other hand, I would think that a diversified lending portfolio works much better than, just concentrated lending in a specific segment. So just a thought on that front. Thanks. Okay,
Deep.
Yeah, thanks. Just a couple of comments, observations, and mostly driven by data from the bureau. I mean, just as I used to be with one of Indian bureaus for some time back, so the data is quite fresh, and the bureau publishes data every 6 months. So as we stand today, the credit access in India is 60%, which is number of people as in the 18 to 60 population who have access to credit. That number is 61%. The OECD countries average is 63%. So if we think that the India has a credit financial inclusion problem, possibly we need to just Google search and relook at the CIBIL as a CIBIL data or any of the other bureaus. Secondly, I think all of us are hopeful at the same time, but generally data people, we tend to be more negative and harsh on ourselves and everyone around us. But possibly it looks like, at least in retail, India has got, and I'm not saying there will never be a blow up, etc., but we have got the thing right. It has been growing at a 15-16% CAGR for over a decade now. Good credit penetration, reasonable cost of borrowing, and if you look at private banks and as well as PSU banks, if you look at one for one, personal loan, home loan, auto loan, the delinquency rates are actually, statistically not significant. In retail, if you actually take block of retail loan in PSU and private, the difference is actually Kisan credit card and agri loans.
Absolutely.
And the point is PSUs are not heavily into KCC and agri loans. So someone needs to push them there. So just some thought, we need to relook at how we are thinking. Home loan, SBI is 25% of the market. Delinquency rate very, very similar to the best private lenders. And in India, if you go anywhere in India, if you are looking for a loan at 10%, you can get it from any of the banks at home loan level. And we often forget there are NBFCs. India has a large number of NBFCs, really large, 10,000 of them. I mean, yeah, they will fleece you in some sense, but the credit access, etc. I think there is possibly a change in academic narrative as well, and look at what has been going right. Not to say there are not risks, there are very large risks building up around the corner, but no one is focusing on them. Anyway, those would be my comments. Thank you.
Thank you. Harsh.
Yeah, so here is my problem. There's a contradiction. On the one hand, we say when these segregated communities are lent to, the NPA levels are the same as normal. So then we have to think, how do you make lending to them a commercial opportunity, not an obligation? All our thinking is we'll make laws and institutions where it's an obligation to lend to them. My point was that when you do things like credit rating agents, bureaus, and make information sharing mandatory, it turns into a commercial opportunity, which is what has happened in India, both with MFI and consumer lending. So then the problem is setting up institution is that very soon it becomes too big and too government to fail. Government-owned institutions never fail. They get bailed out through budgets and so on. I would rather how you incent the private sector, which we have demonstrated in India. What Deep said and what my data that I shared, that from less than 20% of the total banking, it's over 30% now. And with no direct government intervention. And a lot of it is gone in affordable housing and microfinance and so on and so forth.
So I just want to come in for 1 second, then Shubho, then Susan. But Harsh, a lot of the consumer credit lending today is because corporate lending is in serious distress. So these proportions,
but by itself it has grown at 17-18%.
But
so I think when corporate lending getting a
but some of these numbers are skewed because we have a serious crisis on corporate loans. Shubho.
Can I just to your point, right? We have no competition in the banking sector, so it's not a correct comparison to make.
Have you ever tried a home loan? You will see what competition is.
That's again you're back to secured credit. But anyway, I'll hand over to Shubho.
The other aspect of directed lending is the price chasing problem, which is it diverts economic activity towards what is available on the loan itself. So the whole problem with the need to redefine agriculture 5-6 times or every few years is because maybe the loan amount is $1 billion or maybe a few $100 million. But how much economic activity in the economy totally gets diverted based on the loan amount might actually be a multiple of that amount. And it might also include man hours of activity of the poor. So there may be opportunity costs there. And one of the problems that could be that over time, the reason why these things become permanent and keep growing is because many people change their lives, their things based on the amount on the money on the loan, and then they are caught because the only way they can be viable in that business is to get that lower cost of capital, and then it's a self-fulfilling cycle. There is some literature, at least on the federal loan system, that loans are given without any consideration of the repayment rate. I think only a few years ago, the US started publishing repayment rates on federal loans. And, the interest rate on a course which has very low payout is the same as a course which has very high income payout. So, and that might be a bigger diversion than the few $100 million or even a few $1 billion that have been put into that. That has opportunity costs also.
Okay, so we are almost, Susan, last point.
Yes, sorry, I'll try to make it short. So, I know we are skeptical about government starting things with a limited maturity, right? So the statute of limitations is something that we do not think that governments, especially when the program looks like it's achieving its objectives, the government will shut it down. But it's to Bhargavi's point, right? They're making a promise to keep putting this money in. It seems to me that if government has a role to play in terms of overcoming a psychological barrier, it's a bit of they're the ones taking the risk in a certain sense. So it's okay for the government to put in this stuff because there's a noble goal that the market itself is not jumping up to pick up. But there should be a limitation which says either it's 10 years or we'll quit earlier if there is a competitive market that has developed that's now entered and doing this business, at which point we can step out. Just a thought. I know we've never been able to do it. I know we've never been able to do it.
Reagan said that the only thing certain is death, taxes, and government programs. So,
but we'll switch over to another government program.
Okay, I think it's 10:30, and so I'd like to bring this panel to a close. Thank you all very much for being a part of this. I think this is a very interesting question and a very interesting field. And all of us as researchers, I think, there are certain questions that despite many, many years of government intervention, I don't think we still have clear answers to. Starting from, what is the main market failure that we are trying to solve? How do you intervene? Which is the intervention that works? And what are the costs? How do you measure the costs to the system? So it's very easy to measure the benefits because you see the beneficiaries, but how do you measure the opportunity cost or the cost to the system? So I think that, and lastly, how much of certain sections of the society not getting a loan are a capital scarcity problem? How much of it is really a psychological problem? Can we have different forms of lending institutions with different cost structures that might solve some of these frictions in the market? So, as a researcher, I think this is a great research agenda, and I hope that all of us keep at it and meet every year or so to take stock of where we are. So thank you all very much.
Do you want to give everyone a last point?
Sure, if we have the time.
Yeah, we have 5 minutes.
Okay, great. So I'll start with Adam because, we ended, you were the last panelist. So we'll begin with you.
I don't have any final comments. I'm eager to hear other people's final comments.
Okay. Indraneel?
Yeah, I just want to quickly point out that the misallocation of capital in the United States by Fannie Freddie is something which I have found in multiple papers, that what has happened is that as more capital went into mortgage industry, there was less capital available for C&I lending. And I find the same kind of thing in India as well with PSBs, that they consistently lend to firms which are inefficient, which ultimately, when that was corrected, we see about 7% additional employment in the country, in addition to profitability and so on. So yes, I mean, while I'm supportive of the experiment, my research suggests that in general, misallocation of capital is a significant cost, as Renuka was pointing out, we should be concerned about.
Thanks, Indraneel. Deepti?
Yeah, I just wanted to comment on Shubho's point that are people changing their lives in order to make sure they get access to low cost credit, right? Economic lives. And I think that's a serious problem. I feel like, yes, a 7% farm loan, I would do anything to get that versus a 20% microfinance loan to fund my agriculture. And so, and I think that's where the role of these partnerships come in, right? We have NBFCs and other institutions that are trying to solve the problem that in a way that it helps the farmer rather than kind of force fit what the bank can offer into the farmer's life, and so the farmer has to kind of change the way they do things. So I think we should have a grand vision for what is this ecosystem of entities that actually enable more efficient allocation of capital, rather than just imagining banks to do this by themselves.
Thank you, Deepti. Harsh?
No, I think we can keep discussing this. I feel that it goes back to the question I raised, that what is the optimal extent and mode of government intervention? My own view is that our DFI experience tells us that setting up dedicated government-owned and managed institutions is not the right way. We can achieve much more by careful policy and regulatory thinking. I think that works effectively, much more effective than setting up an institution.
Thank you. So Nadav, you have the last word.
Can I just ask one question?
Yes, sure.
I am not aware really about how much mortgage-backed or loan-backed securities have been issued in India. One of the major reasons why home ownership and related development took place in the United States was the creation of these mortgage-backed securities in the late 80s. And I don't think they exist. They have been developed in India to any serious extent. So that's an area which one needs to give a significant amount of thought to in the big picture. Of course, India has had the advantage that India's development banking infrastructure was extremely efficient, but then that was government backed, government supported. While these mortgage-backed and loan security-backed offerings and would be private sector driven and would therefore be long-term more sustaining.
Okay. So over to Nadav.
So yeah, thanks everybody. This is incredibly fascinating. So one quick thought is on the question of misallocation of resources. Sure, that could happen, but we could also look at the other side of that, right? So credit is an important factor in the weighted average cost of capital of almost any type of economic project. So when we bring down the cost of credit or increase the riskiness with loan reserves, et cetera, yes, we're steering economic activity in a particular direction, and that could be a misallocation, or that could be an excellent allocation. If we want to, for example, I know that priority sector lending to renewable energy. Of course, we want to reduce the weighted average cost of capital to renewable energy, and that is precisely a regulatory technique to do that. So in that sense, I think it could also be really, really promising. Second quick point, I think it's very helpful to think of, and one of my big takeaways from our discussion together, I think it's really helpful to think about not just the question of intervention per se and its size, but what particular types of sectors is intervention targeted to? And I would make the case that Fannie and Freddie, which deal primarily with the middle income borrowing market, or the SBA, the Small Business Administration, which deals with small businesses that are relatively established. I would suggest, I think along the lines that Susan made, that this is qualitatively different from dealing in communities that are facing issues that arguably can really not be solved by existing credit markets, even with abundant information. And I think that's an underwriting issue. Thanks again to everybody.
Thank you. Sorry, so I have to give the last word to Shubho.
So now we live in a world where we can track financial transactions, income outcomes for almost perfectly. We live in a surveillance world now. So one of the things I think the new program should do is, instead of doing priority sector loan at the aggregate level, look at the farmers, track them. In some of these lending, we get their SSN and then track over 10 years, 20 years, whether this loan really helps. That sadly has not been done in many of these places, and we can do close cases where people just miss the application for some scoring, just a cut-off type. So I think there's a lot of research opinion to establish this or to disprove it.
Okay, thank you, everyone. I think this was a very interesting session. And Susan, I hope we have more of these discussions next year.
That's up to you and your research promises. So thanks a lot, everyone.